Guys, do you want to understand how you can make more than 55% return on your investment in a year during which the market crashed? Let me explain you how I did in this video. So let's dive in. Many people fear market crashes. It is currently a hot topic, and the fear has been increasing because of the real disconnect we have between the real economy and the financial market. Most investors see a market crash as a bad event because they lose a lot of money when it happens. However, value investors do not see it as a bad event because they often benefit from it. The question is, how do they do to benefit from it? And what can small investors like you and me can leverage from it? And when we look at it closely, there are really three key things that they do differently from other investors. The first one is that they do not participate in the market fully. The second one is that they build up a large sum of cash to invest before the crash happens. And the third one is that they invest heavily when the market crash happens. Let's go through each of those points one by one to get them better. Sometimes people are willing to buy stocks where the price went so high that it is completely disconnected with reality. They do it because they believe in the so-called greater fool theory, which goes like this. Yes, I'm a fool to buy this stock right now, but I will find a greater fool to sell it to later for more. If you add a bit of fear of missing out to this, you end up with a market full of greedy people. All this greed created by those excessive buying activities create a situation where it becomes really difficult for value investors to participate in, because while some investors benefit from this excessive rise, it creates a very dangerous situation for others. When the market reaches those levels, the risk is at its maximum, and you can be the one left holding the bag if you are still buying stocks. Benjamin Graham, who is Warren Buffett's mentor, wrote in his famous book, The Intelligent Investor, that the intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. This risky situation often challenges the value investing principles. When the market is overpriced, it becomes dangerous and difficult for value investors to find high-quality businesses for less than they are worth. They always consider price and value when they buy a stock. The rationale being that if you buy a stock for less than it's worth, you will pay a price that will provide you a margin of safety, and in the long run, the price of this stock will increase and match the value of the company. A margin of safety is a buffer between how much you think the stock is worth and the price you pay for it to make sure that if something goes wrong with your valuation, you don't lose money. And we often use margin of safeties in our real life. So for example, if I have a flight at noon and I live 30 minutes from the airport, I will most probably leave my place toward 10:30 or 11 to make sure that if something goes wrong during my trip to the airport, I can still make this flight. Warren Buffett famously said, "Be fearful when others are greedy, and be greedy when others are fearful." So when the prices match the value of their companies or exceed the value of their companies, value investors often sell their stocks and exit the market. Selling stocks when the market is overpriced usually helps them to go back to cash and be ready before the storms happens. The market usually runs in cycle. It goes up, it goes down, and when it goes extremely up, it goes extremely down afterwards. And a crash is the best opportunity ever to load up on high-quality businesses that you love. To load up on those high-quality businesses and benefit from those opportunities, you need to have some cash ready to be used. And the bigger your cash position, the easier you could seize those opportunities. If all your money is invested in the market, you are at a risk of missing them because you won't have any cash available when the market crash hits. You will be forced to go out with a thimble instead of a bucket when it will be raining gold, and this can be really frustrating. The only way to avoid this frustration is to be patient in cash because we have the opportunity to sit on cash and wait for those opportunities. Successful investing is really a waiting game. Charlie Munger, who is Warren Buffett's business partner, says that you don't make money when you buy, you don't make money when you sell, you make money when you wait. And if we look at Warren Buffett, he is currently sitting on a record level of 137 billion in cash. In addition of helping value investors to be ready before the market crash, cash also helps them to be really aggressive when the crash happens, because they invest heavily during that period. Just as there is a perfect time to sell your stocks, there is also a perfect time to buy your stocks, and the market crash is one of them. In investing, big money is made when you do the opposite of the crowd, and it happens to be the right move. So when it's time to play, it's a fatal mistake to be shy and do nothing, because those opportunities do not show up often, and they can be really brief when they show up. To provide you a funny example, if Beyoncé or David Beckham is in your town and call you to go for a drink, no matter what you need to do the next day, an exam, a run, or whatsoever, you need to say yes. If we look at the last market crash we had during the pandemic, it only gave us 3 to 4 months to buy stocks at an interesting price. And believe me, you want to be decisive during those moments because the market will provide you the opportunities of a lifetime. Many high-quality businesses experience a huge drop during a market crash. Albert Einstein said that in every crisis, there is a great opportunity. And this applies perfectly to the stock market because cheap stocks equals massive gains over time. If we look at the last crash we had in March 2020, Square fell by more than 50%, PayPal fell by almost 30%, and Apple fell by almost 30% as well. The issue for most investors is that they usually do the opposite of what they should do. When the stocks are going up, they buy. When the market crashes, out of fear, they sell. And let me tell you, this is wrong and has never proven to be successful over the long run. While it could seem like trying to catch a falling knife, it's always a good idea to buy stocks when they become cheap. Because the market usually bounces back from the crash, and this is how big money is made by people that loaded the truck when it happened. When you have a long-term horizon, a market crash is here to serve you. And to provide you a few examples, since the global financial crisis of 2008, Amazon grew by more than 8,000%, Apple grew by more than 4,000%, and Microsoft grew by more than 1,000%. This is it for today, guys. I hope you liked this video. If this is the case, feel free to drop a like. And if you want to receive more contents like this, feel free to subscribe. Thank you all. Have a good day and peace out.